Hey Rick,
Hey Megan, how you doing?
so far so good. It's another Tuesday here in the office, and we have some great content for people.
We do.
Last week we did a mock interview, like you were a home seller and
Hmm.
I am a realtor, and uh, which is halfway true, right? And
Hmm.
then this week we promised everybody that we would flip the coin and I would be a first time home buyer. And you, the lender that I called
Hmm.
to talk about how I'm going to buy a house.
Yeah.
And so I have 5 questions for you.
Oh, good. Let's do it.
Are you ready?
I'm ready.
All right. Ring, ring. Just kidding.
Hello?
Hello. Hi. My name's Megan, and
Uh,
I would buy a house. I've never bought a house before. I'm a first time home buyer. I'm also a teacher in
hmm.
Orange County.
Hmm.
And my realtor said I needed to call you to get my financing straightened out before I started to look for a house. So obviously, I have a very smart realtor, right?
You do. Absolutely you do.
So I've got a few questions for you. So one of them
Hmm.
is, can you tell me, is it better if I get a pre-qual or a pre-approval, and which one would you suggest? What's the difference?
Yeah, great question, Megan. I get this quite a bit. And there is a difference, and it's an important thing to know because a pre-approval is not the same as being pre-qualified. So let's talk about what that means. A pre-qualification is where I talk to a buyer. I go over the numbers with them on the phone. Here's your payment. What's your income? What do you have in debts? I kind of run the numbers manually and say, okay, well, based on what you've given me, you qualify for the loan. Your income is good. You tell me your credit's good. Based on this purchase price and this down payment, you qualify for the loan. That's a pre-qual. It's pretty simple. It's a 10-minute conversation.
Phone interview.
What's that?
It's a phone
It's
interview.
a basically a phone interview. That challenge, and that listen, a pre-qual is good for like a discovery phase. If a buyer just wants to kind of know what are the payments, what do I qualify for? Can I buy a house? That's that kind of conversation. The challenge though with a pre-qual is you're not going to be able to get an offer acceptance or be able to write an offer with just a simple pre-qual. Okay. Now the next step is going to be a pre-approval. And so what does that mean? Well, pre-approval is where we actually have the buyer fill out the information on our system, just a really simple form on the computer. We simply ask where they live, where they work, where they have their money, so on and so forth. We will verify their credit. We will ask them for pay stubs and bank statements to validate their financials. And then based on that information, we run that through the system. We get what's called a DU approval. So that's an actual underwriting approval. It's an automated approval, which is a valid approval to make an offer. Because if when we submit that loan to the underwriter at offer acceptance, the underwriter will use that data, i.e., the DU approval and all the data that we've already have to validate and formally approve that loan. So it is a true at that point, a very true, validated, and documented loan approval. And that's what you get these offers accepted on, not the
Hmm.
pre-qual. See the
Hmm.
difference?
Yeah, yeah, much better to get your pre-approval. So, what are
Yeah.
the things that I home buyer have to have handy to submit to you for this pre-approval?
Yeah, thank you, Megan. It's really basic stuff. Most recent paycheck stub, W-2 form, the most recent 1 or 2 years of W-2s, pay stubs, bank statements. That's pretty much it. Now, if they're self-employed or have other types of income, we want to validate that with the tax returns. If they have a corporation, we want the corporation tax returns and the individual tax returns. But that only applies if you are self-employed. If a buyer has a W-2 income, we're not going to ask for those tax returns,
Hmm.
just
Okay,
W-2s.
got it. All right. Now,
Yeah.
how long does this usually take, this process of getting pre-approved?
It's pretty fast, really. We move as fast as the borrower is able to give us the documentation. So generally speaking, depending upon time of day, I'll have that underwriting approval done within the first 2 or 3 hours of submitting their application to us. So it's pretty fast. So if I talk to a buyer in the morning, for example, Megan, and they submit that information to us by early afternoon, we'll have that approval done for you by end of day
All
with
right.
an approval letter for your seller to write an offer.
So
That's
it's
the next
important to
piece.
be prepared and to have all your paperwork ready so you
Right.
could move quickly.
Correct. Correct.
Good.
Yeah.
And since I'm a first-time home buyer,
Hmm.
what kind of programs are available for me?
There's some very good programs out there, but they do have limitations. I mean, first-time home buyer programs are not designed for buyers with no money, no credit, no income. They're not they're not like a freebie kind of a program, but they are incentives. So, for example, we have a grant program
Mhm.
that is a $10,000 grant that's used toward closing costs. And that grant, the nice thing about that grant is that it is forgiven at closing. So we use that grant, that money's put into escrow to help pay for closing costs. And the day we close that escrow, that money is forgiven, no payback required.
Mhm.
So that's a
Mhm.
first time buyer perk right there. So there's other programs similar to that. Some programs have got what they call down payment assistance, where you're essentially borrowing the money for the down payment or closing costs in the form of a second mortgage. And sometimes those mortgages have no payments or no interest, which is kind of neat. And sometimes they can be forgiven over a certain period of time. So depending upon where that buyer is buying and what their income level is, because almost every first-time home buyer program is based on an income or income caps. Okay, so
Mhm.
if they make a huge amount of money, that's hard to get qualified for first-time buyer. But if they've got good income, good credit, and some money for down payment and closing costs, but need extra help for extra down payment or closing costs, those are very good programs to use right now. I do
Yeah,
encourage those.
I do like that $10,000 one.
Yep, it's very good.
Um, all right, let's see here. So interest rates,
Hmm.
so confusing for me as a first
Yeah.
time buyer
Hmm.
because I see ads, online that are
Hmm.
advertising a low interest rate,
Hmm.
but I don't know what that all entails. So how do I make sure that I'm getting the best interest rate?
Yeah, it's a great question, by the way. So, and then it's a much bigger discussion, but the short answer is this. And then, from a consumer's perspective, it's like, who establishes the rate? So, lenders don't wake up in the morning and go, hey, I want the rate to be 6% today. And one guy says, no, I want the rate to be 6.25. That's not the way it works. So all mortgage loans, regardless of lender, they're all the same. They're traded as what's called mortgage-backed security. So it's essentially a security that for that money. It's like buying a stock. And so that trades every day. So the mortgage market, mortgage rates fluctuate throughout the day, just like a stock does. Okay, so that's how rates are established. And they're pretty consistent throughout the day most of the time. Now, what you can do, you can pay points, you can buy down the rates, you can do lots of things to with that rate a little bit. So, for example, if you paid 1 or 2 points, you might get a little bit lower rate than see a 0 point loan. A really popular option, I would like to see it more often, frankly, is what's called a buy down or like a 1-0 buy down. And so what that means is that, let's just say, for example, that today's rate is, let's just say it's 6.5, and you want a 5.5% rate. Well, you can do a 1-0 buy down, which means you buy down that rate for the first year to 5.5%. Then beginning in year two goes back to 6.5. So that's a pretty affordable way to buy down a rate for the first year. But the reality is though, Megan, there is no magic pill here. I mean, lenders will advertise these teaser rates, but you got to be so careful because what they don't disclose on those rates is what the cost is, about the
Right.
dollar cost. And so I've had situations where someone gets a very, very low quote, but then the actual loan cost for the mortgage is like $30,000. Well,
Yeah.
that's a great rate, but it's going to cost you 30,000 to get it. Well, that doesn't
Right.
make any sense, right? But the rate sounds good.
Yeah.
So you just got to be mindful of those types of scenarios. But that's why people have, people like you and I to kind of walk them through that process and help them understand what that means and then how to get to where they want to go.
Mm-hmm. Mm-hmm. Yeah. It gets really confusing, doesn't it?
It can be. There's lots of options. Yeah.
So once I get my
Hmm.
loan, and let's say I want to pay it off early, what's
Hmm.
the penalty for that, or what's the downside of paying off my loan early?
Well, the good news, the law's changed in the recent years. There is no longer a prepay penalty to pay down your loan early. And so sometimes the buyer will say, what if I pay the loan down like 100,000, or if I want to pay it down 10,000 or pay it off, is there a penalty to do that? No, there's no penalty at all to do that. You can pay as much as you want toward that principal, as often as you want, or just pay it off. And there's not going to be a penalty to do that. Now, I will say this. This is one thing I want you to know, and not many people know about this. You have an option. If let's say someone has $100,000, okay, and then they just want to pay the $100,000 down to the mortgage. Okay, let's say, yeah, but does that lower my payments? Well, no, it doesn't. It doesn't lower the payment. If you just do it that way, but what it does, it accelerates your loan term. In other words, instead of having a loan in 30 years, it might pay it off in 22 years if you put like a big lump sum down like that. It does not lower your payment. However, there is a one-time option called a loan. It's called a loan recast. And under a loan recast, you can take that $100,000 and pay that loan down, and then re-amortize the loan for that lower payment. That's important to know, because I've had buyers in the past call me and say, yeah, I'm gonna pay this loan down 100,000. This guy said, go ahead and refinance the house to lower the rate. Don't do that. Don't do that. Don't do it, because the recast, the fee for the recast is like $250. It's super simple. You can lower the payment that way. You don't have to go through the hassle or expense of a refi, unless the rates are super low. Then yeah, do the refi. But if rates are fairly similar, just do the recast. Save yourself a ton of money and still pay the house off.
Yeah, exactly. Well, that's some really great advice. And that's just really chipping a piece off of the iceberg here.
Yeah, no doubt.
That's great info. And how are the rates doing this week? I know it's only Tuesday, but
Well, any of the week seems like it's a long week on rates anymore with all the volatility. The good news, the rates have been really trading kind of sideways the past couple of weeks, up and down a little bit. There's a lot of volatility throughout the day, but it's just, it goes back and forth. So rates have been fairly stable the past couple of weeks. We'll see what the next few weeks brings, but right now they're fairly stable.
yeah, good. All right, perfect. Well, thanks, Rick. Thanks for the info. And if
Thank
you have a
you.
topic you want us to cover, feel free to send us a message and we'll put it on the next one.
Awesome. Thank you,
All right,
Megan.
talk to you soon.
Appreciate you.
Bye.